In this week's video, we'll review all the charts and cover reasonable downside targets for the S&P 500 index. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll kick off this week's video with some DeMark charts. DeMark charts and indicators are proprietary tools from Market Studies LLC. Monthly chart of the S&P 500. Point of the exercise: not to predict or forecast. Point of the exercise is to keep a flexible and open mind. If we look at all possibilities, upside and downside, it's much easier to be flexible. This teal diamond here tells us the probabilistic upside on the S&P 500 is 2024. Here, if we drop below 1907 on a monthly basis, so this is looking out several weeks or several months, below 1907, 1680 is within the realm of reason for the S&P 500, and we'll look at some Fibonacci numbers to put this in perspective a little bit later in this video. Now we're looking at a daily DeMark chart. We want to give credit where credit is due. These diamonds here are DeMark's propulsion system, which helps us with targets or probabilistic upside and probabilistic downside. A target doesn't necessarily mean we're forecasting. We're just understanding what levels are within the realm of reason. On the upside on this chart, 1985 on the S&P 500. The downside on the daily is 1887. Clients and regular viewers remember this excellent analysis from Dana Lyons about V-bottoms. If you haven't heard it or seen it, here's what it basically says. From 1950 to 2012, a V-bottom occurred in the stock market about once every 1.6 years. In this period in here, where the Fed seemed to step in every time the markets became weak, so from March of 2013 to the end of 2014, instead of a V-bottom occurring once every 1.6 years, unbelievably, we saw a V-bottom once every 2.1 months. If we hypothesize that this odd occurrence was partly impacted by the Fed keeping interest rates at zero and intervening when things became volatile on the market's behalf, then it stands to reason that if the Fed is reversing course and at least talking about raising interest rates rather than talking about keeping them low, that we could get a normal retracement of this odd period here that began really in 2012 and in earnest in 2013. So if we did see some normal retracements, what might that look like? This table shows us Fibonacci retracements from a low to a high. We can use retracements off of any low and pair it up with any high. These are the retracement levels based upon the low that was made in November of 2012 in blue or June of 2012. Why we have these highlighted is this low and the subsequent rally is what began the period of the V-bottoms and somewhat of the odd occurrence. So again, using the theory that what goes up might come down, if we retraced some of that odd behavior, what might it look like? These are the fib levels for the retracements. So this would be from the November 2012 low on the S&P 500 up to the recent highs in 2015. One of the retracements would take us to 1830. That's a 5% drop from where we closed on Friday at 1930. Can't emphasize enough, this is not a prediction. What this does, it helps us keep an open mind. When we look at the charts and we see that the probabilities are not in our favor, sometimes it can be difficult to remain patient. Example, last Friday, we had a huge rally in the futures, a huge rally intraday. It's very, very difficult to watch that and say, well, the model and the numbers are telling us not to buy. This helps. Why? The odds in the charts are negative. And these numbers here are telling us that relative to Friday's close, it would not be unusual for the S&P 500 to drop another 5%, 6%, 10%, 12%, 15%, or 18%. And now we're looking at a daily chart of the NYSE Composite Index as of the close on Friday, September 25th. We're looking at Fibonacci retracements. We can use Fibonacci retracements in both directions. Example, this is a high to a low. This is a downtrend here. These Fibonacci levels tell us that when we're in a downtrend and we have a drop from point A to point B, it is normal for a counter trend rally to move to the 38.2% level, the 50% retracement level, or the 61.8% level, and do that within the context of an ongoing downtrend. So visualize this. The trend is down. I get a counter trend rally in this direction into the fibs, and then I resume the bearish trend. Not a prediction there, but we're just saying that's often what happens. So on this daily chart, what this is telling us is the market has not done anything as far as its rally attempts to discount that we're still in a downtrend. If you're a bull, you'd like to see this line close here, here, and better yet, here. When you get up here, then the probability of this trend staying intact becomes quite a bit lower. Right now, this is not all that concerning and is one of the things that can help with that difficult need to be patient. Now we're looking at one of the risk-on, risk-off weekly ratios used by the CCM market model. Regular viewers, longtime viewers, and clients may remember that there's a piece of the model, one of the submodels, that uses 18 different charts. This is one of them here. It's a weekly chart. We're looking at risk-on stocks, the S&P 500 index, relative to more defensive-oriented risk-off bonds, or the intermediate term treasury ETF with the symbol IEF. This is what risk-off looks like in one of the worst parts of the financial crisis. Price is below both moving averages. Blue is below red, and the slopes of both are down. That's our full-bore bearish look. This is a full-bore bullish look. We can see this in March of 2009. Here it's telling us now that the conviction to own growth-oriented stocks is now greater than the conviction to own defensive IEF, or intermediate term treasuries. How does the exact same ratio look today? The answer is not very good. It's relatively clear. In fact, you can make an argument that this period here looks similar to this period here. In terms of the wider spread or broader evidence, the model, as I just said, tracks 18 charts. Some of them are indices, some of them are ratios. Out of the 18 weekly charts tracked by one of the submodels that feeds into the master CCM market model, how many bullish weekly moving average crossovers do we have out of those 18 charts? The answer is 0, telling us that the probability of good things happening is really not particularly attractive right now. It doesn't particularly tell us much about what next week will look like, but we would prefer to see visible improvement before we put our hard-earned capital or start scaling it back into harm's way. Last week, this chart had a full-bore bearish look against stocks and in favor of IEF. Did it help this week? In this case, it did. The S&P 500 underperformed IEF by over 1% over the last 5 trading sessions. This is one of the S&P 500 daily charts that we've been using in these videos to help us remain patient from a probabilistic perspective. You can see we closed below this band that we've been watching, 1972 on the lower end of the band and 1993 on the upper end. We closed here on Friday. These are not particularly confidence-inspiring candlesticks here, nor is the look of this chart right now. We don't make decisions based upon candlesticks or looks. It just doesn't look good. Even if we just came down to this level here, you're still looking at 1870-ish on the S&P 500. Again, no predictions. We absolutely positively could move in this direction next week, and we could clear 2034. Is it a high probability event? No, but the probability is never 0. What are the odds that the S&P 500 holds above the October low? Since we pay attention to the observable evidence and we need to have an open mind, it's probably better for us not to answer that question in terms of nailing down a probability. Example, if I tell you there's only a 1% chance that this chart will move into this area here, that's going to create bias. So I don't know what the probabilities are, but I do know this, that the October low on the NYSE Composite Stock Index, which is a broader index than the S&P 500, has been taken out. This is the closing low here, and we've closed below it several times. Does this tell us that the S&P 500 will do the same thing? Absolutely, positively, no. But it does tell us that we should keep an open mind about the S&P breaking the October 2014 low. We'll take a moment here to update regular viewers on this weekly chart that we've looked at. Bullish breakout here. This is a long-term chart. Goes all the way back to 2006. This is a bullish breakout. Fractals now tell us that this could be classified as a failed breakout. We've come back up to this level here, and we're still below it. So as long as we stay below this blue line, it tells us to respect more downside from a probabilistic perspective. Since there is no magical chart, indicator, or risk-on, risk-off ratio, the market model is highly diversified. Regular viewers know this is what our full bore bearish look looks like that we just covered, so we don't need to cover it again. This is the look in 2008. This is the look in 2009. How does the same chart look today? As of the close on Friday, September 25th, the weekly chart has a full bore bearish look. We'd like to see this improve. It hasn't occurred yet, but we'll keep an open mind. We close below all of the relevant weekly levels that we've been watching. We're using the same concepts here, just a little bit longer duration on the weekly charts. In this case, a full bore bearish look is when blue, the fastest, is on the bottom and the slopes are down, price is below. Here, your full bore bullish look, we can see improvement here in 2009. Blue is on top and the slopes are all up and price is above. This looks quite a bit different than this. How does the exact same chart on the exact same time frame using the exact same moving averages look today? The answer is unfavorable as of the close on Friday, September 25th. This looks a lot more like this unfavorable period here in 2007, 2008 than this favorable period here in 2009. This chart can help us with one of the most difficult things in trading and investing, which is remaining disciplined and understanding that the do-nothing alternative is always an option when you're waiting for your signals under your system. The charts that we've shown here this week made it relatively easy in terms of implementation to do nothing on Friday when the futures were up big and we had the big intraday rally that eventually was retraced. It didn't make it easier from an emotional perspective. The model gives you a rational guidepost to manage off of, which can help you control your normal human emotions. It's much, much easier when the markets are up big to wake up, prepare buy orders, and when the market opens, execute them, because as a human being, we feel better. We've done something now. It's harder to look at your model or your signals or your system and say, I know based on experience that I have to remain patient until my system or my signals, or in our case, the hard evidence in the market model, tell us it's time to take action. We don't know when that will be. It could be next week, it could be in 3 days, it could be in 3 months, or it could be in 3 years. The key to success here when we're rolling over, it's difficult, is to implement consistently over time. We don't know what's going to happen. We've migrated to a more defensive posture if, and I emphasize if, the S&P 500 takes another leg down, we should be well positioned for that leg. If that doesn't happen, the evidence will tell us when it makes sense probabilistically and from a risk-reward perspective to start scaling back in with our hard-earned capital. As always, the markets will guide us if we're willing to listen with a flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The sub-models, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The sub-models allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.